very much.
Thanks very much. Now, I'm usually quite loud, and I thought, oh, blimey, this is going to be really loud. But as I'm competing, I think, I might have to turn the volume up a bit. I have actually had audiences in the front row complain that I'm too loud, but I will try not to be too loud today. Right, is that tolerable? Yeah? Okay. Right then. Well, I thought I've got an hour, but we're going to do a Q&A, and you can ask me anything you like in the Q&A, but I thought I'd pick up on a number of tax changes and what looks interesting and what looks like there might be a bit of business in it and stuff like that. So stuff that's a bit more interesting than just boring old tax rates. I started off with what's a bit of a pet topic of mine at the moment, R&D and patent box. Actually, I should say patent box because that's the right way to pronounce it. But on R&D, there's recently been some stuff published to show that in the SME community, only about a third of the companies that could claim are claiming. Now, clearly, that third who are claiming are represented by us because we're really good advisors and we don't miss a trick. But please don't overlook R&D. Here are some examples of R&D things that have had R&D relief. An industrial cheese grater. I don't know why someone needed an industrial cheese grater or what technological uncertainty was resolved in doing the R&D, but that's to give you an idea, because what a friend of mine said is that unfortunately sometimes people get white coat-itis. And they think that R&D is about chemistry people with conical flasks and Bunsen burners, and if you're not that, you can't claim R&D relief. Very, very common in engineering. I've got a big client that claims lots and lots of R&D. So really, look at that offer, 225% tax relief. You don't get that every day. It's the most generous incentive scheme that we've got. Do look out for it. Do think about your client base and who might be able to benefit from R&D relief. Just always keep your eyes open for it. Had a very telling question at a conference recently. A gentleman put his hand up and said, how far can you backdate an R&D claim? Now, sadly, the answer to that is 1 year, but what, of course, he gave away is that he thinks he's missed one. So bear that one in mind. And then very, very new, only just here, the patent box. Now, your clients might not be heavily into R&D now, but they might have a patent over a process or a product or something that they've done way back in the past. If that patent is still valid, and it needs to be a UK patent or an EU patent, they'll be able to get a much lower rate of corporation tax on the income deriving from that patent. Now, one of the common misconceptions is that this is for patent royalties. It's not. It applies to the sale of very clever vacuum cleaners by Mr. Dyson. Okay, it applies to Viagra, but not after this month, because the patent runs out on Viagra this month and all the copycat businesses will be jumping in. But at the moment, Pfizer could claim patent box on their profits from Viagra, which I've no doubt are considerable. So essentially, it's a case, again, of not thinking maybe about scientific businesses, but any businesses, you can patent a process. It also says to me, talk to your clients who are innovative. They might not have done R&D within the definition of R&D relief, but look and see what you might be able to get patented. You've got an idea, you've not claimed R&D relief, okay, but if you can get a UK patent over that, you're heading for 10% tax. Now, it's being phased in, so at the moment it's 14%, 13, 12, 11, 10, so 10% tax. And let me just take a step out of your own practice and look a bit more globally. We just beat the Belgians and the French and the Swiss at a low tax base for patents. Now, Margaret Hodge would be delighted to hear this because she's angry that the Irish have gone lowballing on the main tax rate. But actually, in terms of IP, intellectual property, which in fact you don't have to put on a boat to move it to the UK, you can just send it there. We actually now have got the best tax system in the world for intellectual property. It might benefit your clients, but I'm going to tell you it wasn't written for them. It was written for people like the majors, the GlaxoSmithKlines, maybe even Apple. But I don't think we can tempt them. They're locked up somewhere in an island, somewhere off a coast. But that's the idea behind it. But there is a big worry at government that small businesses aren't going to realise and they're going to miss the boat. So obviously you as advisors, you'll make sure that that's not the case. Now, I promised in my brief that I'd talk a little bit about cash accounting. Oh my goodness, time to go to sleep. Never, I will say, has a subject caused more ruffled feathers, and I will say even more than the tax agent strategy 3 years ago, and that caused a few, but cash accounting, everybody got so wound up about it. Now, I'm in a room full of accountants. You don't need simplified accounting. You can not only spell accruals, you can do them as well. So forget it. It's not written for you. You probably didn't know that fact on the screen. 50% of small businesses don't have an accountant. Okay, how on earth do they fill in their tax returns? And the answer to that has to be the word badly. Okay, and do they do accruals accounting? They can't even spell accruals. So what this is, just think about it for a minute, okay? Let's have a builder who's doing a bit of DIY tax return as well. So he's got a few bits of paper together and he's added it up and his calculator's working and he's just filling it in and he goes under inquiry. And what he hasn't included is his debtors. What he hasn't included is his unbilled work at the year end under UITF 40, at which point he doesn't know what the inspector's talking about at all. Now, both of those, don't forget, will give you a plus to profit. So if I was an inspector, I'd go round, I'd whack them all for debtors and UITF 40 adjustments, I'd get loads of money in, and I'd probably get a CBE for being a very good person in the civil service. Okay? Now, so where we are is this bonkers scenario where we all pretend that people who do it themselves can do it properly and they can't. That is what this legislation is for. It's not for us. We're far too clever. We don't need to go on to cash accounting because we know how to do it properly. So, small businesses who add up their receipts and take away their expenditure, ignoring the odd pair of shoes they claim for that they maybe shouldn't, they're going to be just about right now, going to be pretty near the answer. So you see, what a room full of accountants wants from me on a cash accounting session, and I'm sorry, there's a guy doing an hour on cash accounting later on. I've probably just blown his audience for him. You don't need to know about cash accounting. This is what you need to know. What do I say to my client when he comes in and says, my mate down the pub says it's a really good new thing, it's going to save you a load of tax, and it's brilliant, and it'll cut your accountancy bills. You want an answer, and I'm going to give it to you. It says, dear client, I've thought carefully about your position. I've considered all the advantages and disadvantages that cash accounting has to offer you. First of all, I'll tell you my fees won't go down much because you are absolutely hopeless at keeping a cash book. Okay, if there is a cash book, and you know, this is the point at which there are various client spreadsheets running through my mind thinking, oh, it's awful. I reckon on small jobs, and a lot of mine are small jobs, I reckon on small jobs, if I can balance the bank, I've broken the back of it. How long will it take me to come up with some accruals, prepayments, debtors, and even UITF 40? 5 minutes, which pales against the day and a half it spent me trying to work out what the hell he's done in his books. So it's not going to save him much fee. So let's get that one out of the way. Then he might say, but my friend said that it means you won't have to recognise debtors or stock in the year, and also UITF 40. No, he didn't, because he doesn't know about that. So it could save me some tax this year, to which the answer is yes, it will. But let me ask you this, my client. Do you think on the whole that tax rates are falling? And I think that would be a no. Let's ask him another thing. He won't know the answer to this, but I think you do. Do I think on the whole that NIC rates are likely to fall in the future? Oh dear, that one's likely to go up. You know, they found out there's a soft target there, and I reckon they'll give it at least one more hit. So, I mean, 10's a nice round number really, isn't it? Okay, so if I delay you some income, I'm delaying that into the future. We don't know what the tax position is going to be, but I think we can be reasonably confident it ain't going to be a lot better than it is now. So I'm not actually really giving you much apart from some cash flow. And again, if you act for these small clients, one of your big deals is trying to get them to put the money away to pay the tax. And what you'll do if you go on to cash accounting is you will exacerbate that roller coaster ride as profits rise and fall. You know, I have clients who every other year get a tax refund and every other year burst into tears because they can't pay, because they've made no payments on account and they've got a thundering great payment to pay. All you'll do is exacerbate that. So I'm not a fan. I'd rather just keep it nice and as even as I can. But, Mr. Client, in thinking about this, I have to tell you about some downsides your mate down the pub doesn't know about. The first thing he doesn't know about is if you happen to make a loss, and that might be because you bought a new van and you claimed AIA, you will not be able to set that loss off against your rental income on your buy-to-let. You will not even be able to carry that loss back against last year's profits. The only thing you'll be able to do is wait for the benefit of that loss relief in the future. So I've thought about it carefully, and that's one thing I think is a bad thing. The next thing is I noticed that you've got a £10,000 bank overdraft on your business account. Well, I'm sorry to tell you that you're only going to be able to claim £500 a year in interest in future, either on the bank or a bank loan or whatever it is. Okay, and Mr. Client, even if you haven't got borrowings now, you might need borrowings in the future, and interest rates aren't always going to be as low as they are now, so I think that's probably not a bet either. And then finally, and one of my favourite dodges with these very little clients is, what I do is I moderate the capital allowance claim to make sure I use all my personal allowances. And nowadays, of course, they're much bigger, and there's much more call for that. I can't do that for you under cash accounting. If you buy a van, we better make it a van. If you buy a van, then that has to go in. Then you'll get a loss, then you won't get relief for it. See, you need an accountant. And I'm not even going to charge you for this advice. There you go. There's your answer. Mix and match that up and you'll shut them up good and proper. So that, I think, is all you need to go back to cash accounting, so don't bother to go to the other tool. Okay. Flat rate expense, I've had quite a few questions about this one, and I think there are some issues. One of the things is that originally it was going to be mandatory if you went on cash accounting, you had to use these. That's now not the case anymore. On car allowances, I think the idea there's no turnover cap, this is not cash accounting, this is any income tax business. So you may have clients doing 45p a mile anyway because they're below the VAT limit, and that has been around for a long time. If they go over the VAT limit, they have to change to apportionment. Okay, next time they change their car, they have to change to apportionment, and now they can stay on 45p a mile. So I think that's good. Slightly bad news, a slightly bigger business that's got more than one car. Now, my business is an income tax business. I'm not a limited company, and I've got two vehicles on the business. One is mine, which he doesn't get to drive very often because it's a Jag. I will say 45p will put tyres on it, but not fuel in the tank, I'm afraid, but never mind. And then a bigger vehicle that if we're going somewhere, my husband drives me long distance, we can just chuck everything in the back. So I've got two vehicles on the business. My 10,000 mile band at 45 is only one lot. Okay, so if you've got more than one car on the business, that's maybe not a sensible way to go. So you want to think about that. But it is, of course, for small businesses, about 1 million times easier and therefore cheaper for your client, because you're not wading through. And of course, what do you never get? The insurance. Never, ever, ever get the insurance. When you ask him for all the car expenses, that's the one you've got to go back for. Now, use of home is an allowance depending on how many hours a month, their monthly hours, you spend working on the business. Now, the cut-off is 25, so that's about 5.5 hours a week. If you're below 25, this says you can't claim. Okay, so that's one. Now, actually, of course you can claim, but what you'll be claiming is on the apportionment stuff in BIM. And if you remember in BIM, there's all these screeds of time available, fixed cost, variable cost, time actually occupied. There's examples of all sorts of crazy working patterns. You can use BIM to claim a percentage of the actual. Generally speaking, it won't be very much money, but it's better than naught. If you can get yourself up to 25 hours a month, then you're claiming, I think it's £10 a month, it isn't much, okay? So bear in mind, what you're worried about is £3 a week. Because for ages, we've been able to claim £3 a week for the self-employed on the basis that that's what's allowed to employees. That is sort of concessionary. So this is the law. So you will not be able to go to £3 or £4 a week. You will have to go on these, and I have no doubt whatsoever that HMRC will be enforcing it. Okay, so you'll need to track back onto these rates or use the actual. And then finally, the add-backs for mixed-use premises. Now, I'm only a country bumpkin, and the mixed-use premises that I know about is a tiny little pub, but there is a he and a she living in the tiny little flat in the tiny little pub. And a £500 a month add-back is outrageous. That's less than the costs of, at 6,000 quid a year add-back, you are joking. You only get about 15 people in the bar. So it's not going to be for most people, but those are an add back rather than an allowance. So have a think about what you want to go. They're there on offer as simplicity. That's the only reason you're going to do them, is to simplify life. Now, I've been widely reported on this subject just after the budget, and it moved, because in the budget publications we didn't get the exemption. So what I want to do is just reassure you on direct to loan accounts. And the answer is you're probably okay. You're probably okay, simply because if the loan account is cleared by salary and dividend, as it so often is, there is an exemption in the legislation that allows that to be not caught by these rules. So these rules are simply looking at people who have a big DLA, they don't want to pay tax on the income, they borrow the money, they pay it in 3 days before the year end, and they take it back out again 2 days after the year end. And bless them, they think it doesn't show in the accounts. I have news for them. It's called the related party transaction note. They should turn past about page 3 and they'd see it there. But they think they're under the radar, bless them. Now, those people, you're going to have to tell them that their companies have to pay the 455, because pretty much this will cover it. Rule 1, if you pay back £5,000 and you take money out within 30 days, those two are netted off together, okay? Which is a bit limp, because all you do is take it out on 33 days, not 30. So the second one will have you anyway. If your loan balance is 15,000 or more, then there is no window. There is no window. If there is an intention or an arrangement to reborrow, then actually that is ineffective. And the intentional arrangement to reborrow would be evidenced by the fact that you've got a 42-day loan and you need to pay it back to the bank afterwards. So those, I think, careful. Now, let's just turn it slightly and say there are clients who take large cash deposits out of their company bank account because Barclays will only pay them 0.25%. And they stick it somewhere where they can get a jolly good rate of interest. But they do that not to withdraw the money to spend, but actually to get a better return on it. Now, be careful. You need a trust deed, okay? You're going to be fine. If that money is held on trust for the company, then you'll be absolutely fine. Obviously, report the interest in the company accounts. That gives you that opportunity to do that, but it must be held on trust. So you can still do that sort of thing. Oh dear. I better mention this because it's hoving into view on your tax returns that you do now. And really what I want to do is just have a look at some of the practical issues for you. So let's start with those wealthy clients. At least one of the couple has got income of over 60 grand and they've said, okay, forget it, I don't want child benefit anymore. That's me. Okay, now you act for that client. You may have advised him about that, or you might not have. He may have worked it out for himself, bless his heart. But what does he think is your role in monitoring for an income drop? Because if you get an income drop, you can go back and you can reinstate your child benefit claim within 2 years. Now, does he think that's your job and you'll tell him when to claim? More to the point, do you think that's your job? Okay, and I'm going to say a very unkind word, it's there on the slide. What does your letter of engagement say? And I suspect the answer to that is absolutely nothing. Right, so you need to cover yourselves off, because the trouble is, let's put this in front of a judge. He's got 4 kids, okay, so that's child benefit of what, about £3 a year, and he's lost out on 4 years child benefit, 12 grand. And he says, but I expected my accountant, he does my tax returns, he knows what my income is, I expected my accountant to tell me my income had fallen below 60,000 or 50,000. And you say, well, that wasn't what we agreed, that wasn't in our engagement. So the judge says, let's have a look at the letter of engagement. It says absolutely zero about it. And then the judge has a little bit of a think, and he thinks, do you know what? I think it is you. Because you know what the figures are. You'd be a bit thick if you didn't know about child benefit, because it's on the tax return. I think it's your fault. Of course, more to the point, your insurers will think it's your fault. They'll pay up and then wallop up your premium for you. So get that covered off. Now, let's turn to the slightly more difficult scenario. Your client has not disclaimed child benefit because he's in that 50 to 60 band. So you're going to have to put a figure on the tax return. Now, in lots of cases, your client will be the higher earner out of the couple. It won't be a problem. But in some cases, you're going to have to go delving to find out what his partner's income is. And remember, they might not be married. They might be just good friends, as it were, but they are living together as if they were either married or civil partners. No, I don't know how to cover off that fact. You know, how are you going to ask them that? Well, yeah, you're at the same address, but, you know, do you know, I don't know. Very challenging, isn't it? But hey, HMRC think they've got it covered. Anyhow, what's your partner's income? How are you going to get that information? If your client says to you, oh, well, his salary is 24,000 a year, are you going to take that? Or are you going to say, yeah, but what about his share options of 150,000 quid that you don't know about? So you're going to get into awfully deep water here. It's only due by your client if your client is the higher earner of the couple. Okay, so you really need to think about it. And I'll give a little plug for my my faculty. I was introduced as Deputy Chair of the ICAEW. Whoa, that'd be good. Actually, I am Chair now. I was Deputy Chair of the Tax Faculty of the ICAEW. And I know, because I helped edit it, there is a great publication available from the Tax Faculty. You don't have to be ICAEW to join the Tax Faculty. I'm not supposed to do this, but hey, they're not listening. But do join us, and there is a good one. It's got engagement letters in, it's got checklists in. So for members, that's the sort of thing we offer. We try and get alongside you in your practice and say, here's how we can help you. So if you're a member, dig back into December, January, you know, when it was all going on, and find that. You'll find it very, very helpful. Very tricky, very tricky. Dividend v salary. Well, of course, it's dividend, isn't it? Low salary, high dividend. I think everybody's gathered that one. But what we've got now is quite interesting. We've got personal allowance of 9440, and we've got an entry point to NIC of 7696. Now, that's the biggest gap between those we've ever had. And it's going to get bigger next year, because the personal allowance is going up by about 500 quid, and the NIC threshold will only go up by inflation, well, 2, 3, whatever. Okay, so what that does is it means that you actually pay a little bit more corporation tax, because that salary would come in as a CT deduction. Doesn't really affect your tax on your divvies. But what it does do is it jacks up that corporation tax bill a little bit more. People will say wasted personal allowances. You have to really get into the comp and think about what it's doing. So, okay, what's happened this year is that for small businesses, let's say 30,000, 40,000 profit, you're actually slightly less well off in terms of being a limited company this year than you were last year. You're still winning hands down, but it's about 300 or 400 quid less. Okay, now I put next year. What do we know about next year? Well, we know it's the year before a general election, that's for sure. And here comes this fantastic employment allowance, which is basically the first £2,000 of nick for the employer magicked away. Now, that's any class 1. I don't think it's going to apply to class 1A, but there's no rule that says it can't be the only director that's benefiting from it. Businesses will benefit in different ways. The key to this one is it is a universal benefit. Oh, that's interesting. Okay, that's becoming quite unusual now. But what the minister explained at a session on the day after the budget is he said, NIC holiday has been a complete failure. Only 22,000 businesses have claimed it in 3 years. We've nowhere near reached where we were trying to get. There's a massive underspend, which only Danny Alexander is pleased about. And actually, we need a way of getting to small employers. And we've realised they don't like filling in forms, they don't like registering on the interweb, they don't like having to do all sorts of hoops. And anyway, they never find out about it till it's too late. So we decided we'd just give it to everybody. Yeah, all right, Google will get some, Starbucks will get some, but they're only going to get £2,000. And hey, Google and Starbucks have employees in the UK and do pay UK tax. It just isn't described as corporation tax. So what we've got is this allowance, and that is going to change the dynamic in the limited company, because what you're going to do next year, I confidently predict, is pay all your directors a personal allowance. It's going to be 10 or thereabouts. He'll probably round it up a little bit, or unround it up, I should say, in the budget. But essentially, that's what you'll do next year. Now then, little practical warning. If you do that, and the employer nick is 0, there is a bit of employee nick. So you're going to have to get them to focus carefully on paying that on time, because there will be automatic penalties for late payment next year. If you do annual scheme, then you're probably okay, because it's just one hit and you can ring them up and say, here, pay this now. Okay, but just be warned, that is a great benefit, but it comes with a practical issue that some of you with lots of these companies are going to want to have a bit of a reflect on. Okay, what's next? I've forgotten what's next. Oh yes, shall I worry about PA Holdings? Lots of people tell me. Is it a problem that they've withdrawn their appeal to the Supreme Court? And the answer to that is no, absolutely not. Main reason is that if PA Holdings tried to pull that stunt today, they wouldn't be able to, because legislation was put in place starting December 04, but actually in Finance Act 05, to actually shut it down. And that section number there is part of a chapter. That chapter was directly aimed at the PA scheme. So if they tried to do it today, it wouldn't work. So if you're now saying, I'm really worried because PA Holdings lost and I'm worried about my clients, by implication I'm saying to you, why aren't you more frightened of Section 447? Because if you think what you're doing is like what PA Holdings is doing, you can't do it anyway. But I know actually what you're worried about. And we all have this little bit inside that goes, I'm ever so nervous about low salary, high div. I'm wondering when HMRC are going to decide to kick it into touch. And we've been feeling that for years. I do as well. I might be a speaker, but I'm a practitioner too. And we've got that innate worry about when is it going to come to an end. And no time soon. What we were given at the time this legislation came in is we were given an assurance. If it's a genuine business and it decides to distribute as divs, not salary, that is absolutely fine. And what the tax faculty has done, along with the other professional bodies, is we've asked HMRC just to reiterate that. It's there in writing, it's in the manual, but we've just asked them to say, yeah, let's gold plate it. Let's say absolutely. Okay, I'll give you one fright. Let me tell you mainly why PA went over. Because it was a bonus scheme. And all the documentation sent out to staff said, would you like to join the new bonus scheme? And in the accounts, it said we've got a new bonus scheme. And when they sent the letter to the trustee of the EBT, they said, here are the people's bonuses. is it terribly surprising that it took the Court of Appeal to decide that it was a bonus and not a dividend? Okay, so here's the fright. I'm going to ask you a question, brace yourself. When your clients write out checks themselves out of their companies, what do they write on the check stubs? Because if they write salary, you're in trouble. Okay, so write loan, write divvy, write drawings if you like. Don't write salary. It's as simple a little trip up as that. Okay, now I've got a little bit longer before we go for questions. Oh yeah, RTI for directors, ooh heck. Okay, lots of people have got in a right old stress about this. The problem is, and I'll take quite a conservative view on this. Let's just have a DLA on the screen so we can see what we're doing. Oh no, not that colour. Let's try again. Okay, here's a DLA in debit, as they do. And at the end of the year, the magic journal fairy comes. And the magic journal fairy has 2 journals. The first magic journal is called Salary of 7696 this year. Okay, so I've disappeared some of my loan account. Now the other journal, this is a very special magic journal because you have to do loads of paperwork first. Yes, nod now. Okay, but eventually you get to do the other magic journal, which is called Divvy and is called The Rest, and that clears down the loan account. Okay, that's, let's be truthful, that's how it's operated for year in, year out, okay? And it's worked pretty well, and nobody's particularly stressed about it. And remember that new director loan stuff, we're okay with that because there's an exemption. But where are we with RTI? Okay, now here's where I'm conservative. It is possible, there is case law to say that he was actually paid that salary on these dates. Now you can say to me, because we would have an argument about it if I was HMRC, and you will say to me, that's not pay, that's a loan. And until I put through a salary, it remains a loan. Okay, but I'm going to go back and say that, that was the argument made. It was in a case about PAYE liability, but what the judge said is actual payment is when the checks are written. And it was about failure to deduct. So he established that for PAYE purposes, a deduction is made when actual payment is made. Now, that's a risk. You can put in place a loan account agreement and you can kick it into touch. For me, I'm too busy. I am not going to have an argument about this with HMRC. I haven't got the time. So I'm going to err on the side of safety. And what that means is that when I put through a salary journal, and it doesn't matter if it's once a year, once a month, once a quarter, whatever you like, but when I put through a salary journal, if the loan account is in permanent debit, then I am going to write a cheque for that amount. And that stops any of the other payments being treated as salary. Okay, now I might do it monthly, run the payroll monthly, he draws down £1,000 a month, and I make a file note that of that 621, or I think it's 640 something now, is salary. That's fine, don't need to draw a separate cheque, but what you're trying to do is lock together a payment and an RTI run. Why am I so sensitive about this? Well, the answer is, if this all goes belly up and HMRC starts stomping all over you, in a year's time there are going to be penalties. And I will tell you that if they cut up rough, you could be facing an £1,100 penalty on that. Okay, because it's £100 a month except the first, and if there's £1,100 per client at stake, I'm going to be conservative. Okay, so you take your own choices about it, whether you go annual, monthly, quarterly, 3 months in advance and then another 3 months, but where it's in permanent debit, that's how I'll do it. Now another way is we start the year with that very rare thing, a completely clear loan account. Now, if you do that, when you journal the salary in, okay, that's the date that you've operated PAYE. So let me go back to the other slides very carefully. Okay, I'll tell you where this is so you can jot it down if you want to. And I'm very, very kind because I'll tell you what page it's on as well. CWG2 is the employer's further guide to pay as you earn and national insurance contributions. And if you can't find it, go on HMRC's website, in the white space, put CWG and no space 2, and it will come up, okay? And what that gives you is, this is such basic stuff. This is stuff you learned so long ago, you've forgotten you even knew it. When a director has to pay, account for PAYE, and you remember it's the earliest of these, and oh look, it's all coming flooding back, okay? Now what I'm worried is, with a debit balance and a permanent debit balance that never goes away, that's why I was worried about that one. Because if that's the earliest thing that happens, then that's when you should be doing the RTI, okay? Now, if instead I start with a nil balance or even a credit balance, now that's a rare thing, okay, then the first thing that happens is my journal entry. And if the first thing that happens is my journal entry, it's very, very easy to put a journal entry through and run an RTI, and then I'm done. And with a bit of luck, HMRC will get their annual schemes software to work in a few months. What a palaver that's been. The latest on annual schemes is, now you can register for them, they've opened that back up, but it doesn't work. So you still have to send either an inactivity or nil EPSs until October, when they hope it will be fixed. Don't hold your breath. Yeah. Okay, I'll comment on that. Okay, the question is, can you write, I heard that somebody did that. They wrote to Long Benton and they registered 10,000 clients as annual schemes on the same day. So I sort of understand why they suddenly said, oh no, we're shut, too late. Strictly, it's by phone call to the employer payment helpline. But I know the guys on that have actually been creative and have said, okay, fax us a list and we'll do it. So HMRC will be sniffy and say, oh, no, you have to ring up for every single one. And I want to say, listen, it's your phone lines getting blocked up, but they will be reasonably flexible. But at the moment, you've still got to find nils, which is the entire point of an annual scheme. So never mind, they're getting there. So that I think will cover off Director's RTI for you. Do you know your PIPs? This is scary if you don't know your PIPs. This is very scary. Brace yourselves. Oh, come on. Okay, here is time going along. Here is April 13. Here is April 14. You know that the annual allowance is going down to 40 next year, but it remains 50 at the moment. You have a client who about then, okay, doesn't matter when it is, put 50 grand into a pension scheme. So on the tax return for 2014, you entered that 50,000, okay? Right, the good news is you're not wrong. Good start. Here's the bad news. You now need to ask your client, or you check your files, what is the end of their PIP, their pension input period. And that's normally driven by when they made their first contribution, although if that goes back pre-A Day, the answer is very unpleasant. It's the 7th of April. So let's say you asked your client and they said, my PIP date is there. Doesn't matter what it is, have a look where it is. And if the PIP date is there, then that contribution falls in the PIP ending over there. And that means you've got another tax return to do, and your tax return for 2015 says my client has exceeded the annual allowance. And on the additional information pages, on page 6, I'm helpful today, I'm full of page numbers, you will put £10,000. Now, have a look, right, okay, annual allowance charge, 10 grand. Now then, worst case scenario, When I paid in my 50 grand, quite a lot of that only got basic rate relief because I didn't have a lot of income. When I get charged in the following year, it comes back at my marginal rate of tax, which is that year 45%. Oh dear. Now, it might happen the other way round, but there you go. It's more likely to happen the other way around if you think about it. If you put 50k in, it might be all your income for the year, so that wouldn't be good. Okay, so the question is, do you know your PIPs? Anyone who starts a pension arrangement after 2011, hurrah, it's the fiscal year, forget everything I said. But you're bound to have clients who've got other arrangements. Okay, 1 minute to go. Let's see what the next surprising slide is. Oh, I did that. Oh, right, okay. Now, there's a whole thing on auto-enrolment, but you just missed it, but it'll probably run again tomorrow. But let me just sort of give you the practitioner's angle on it. I reckon that you'll need about 6 months to get your ducks in a row. Okay, and that'll be, you know, telling clients and helping them get the communications right and deciding where they're going to put the money, blah, 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 blah. It'll go on and on and on. So what you need to do really is think about when your clients are first coming in. Now, the staging dates runs 2.5 pages of A4, so I haven't bothered. But I've given you a taster. I've given you just 4, just to give you an idea of how near it is. So last month, employers with between 4,100 and 6,000 staff joined auto-enrolment. In October, it's way down to employers with 800 staff up to 1,250. From next April, we're down to 160, and then less than 50 start coming in June 15. Okay, so that gives you a bit of an idea. I'm all right, all mine are June 15, so I'll put time in the diary now at the back end of 14 to get myself fully up to speed on this one. Okay, and if you thought RTI was tricky, you just wait. But Sage will help you because that was their thing. Okay, oh right, I'll do this. This is my very last thing, and then we can do Q&A. Right, I keep getting asked, are you doing 3 hours on universal credit? And the answer is no, I'm not. And there is, and why? There's a really easy answer. It takes me 3 minutes for you to decide you're never going anywhere near it. So I don't need to do 3 hours on it because you're never going anywhere near it. First of all, it's cutting in at a very, very, very much lower income base. So those clients who are getting WTC and CTC now, most of them will drop out. Okay, so that's one. Number 2, nightmare. Monthly accounts submitted on the internet. Let me go to it. So if you claim universal credit on the 16th of May, you've got to submit monthly figures to the 15th of every month. And remember, his income must be very low or he wouldn't be getting any. So how are you going to bill him? Okay, and then we come to the idea of how we work our accounts out. It is the cash in, cash accounting, cash in, less cash out. But because universal credit tapers on post-tax income, you knock off the tax. So that's going to be fun. Twice a year, we're bound to go minus. So let's talk about losses. Let me go back. There are none. If you get a loss, it's not a loss, it's naught. What you actually have is, if you're an established business, is you don't even have naught. You will always be deemed to earn at least minimum wage, whether you do or not. So you guys have spent ages going through, oh, by the way, you only have 7 days to send the accounts in. So you've spent less than 7 days going through, you've added it all up, you worked it all out, and the answer's a lemon. Because minimum wage is more, so you can chuck that away and start again. Absolutely dreadful. And then finally, let me show you this because you'll love it, okay? Here is why you're not going anywhere near universal credit. You don't count stock because it's cash accounting. So my client goes out and buys a load of stuff in period 1 and he travels around buying all his stock, and then in period 2 he opens a pop-up shop and he sells them all, right? So that's 1 month and then the next month. In the first month he's got no income, so it's naught or it's minimum wage. In the second month he's got a profit which is called his turnover. So he can't claim universal credit in period 2 because he's got a whacking great profit, probably couldn't claim in period 1. When you pay your tax, you'll go into loss. Oh, that's not a loss. Have I sold it to you? Don't go anywhere near it. If you feel strongly, volunteer for the CAB. Okay, but tell your clients, it's not, be frank with them. Say, I can't charge you a market fee. So you're going to have to get the advice elsewhere because I can't do it for less than what you get out of it. Okay, so any questions? And we got someone with a roving mic. So if the lady brings the mic over to you, then I'll be able to answer it. You can ask me anything you like, within reason.
Going back to what you were saying about RTI and overdrawn loan accounts, what I've done for my people who are in that situation is to knock up loan agreements, plus all the backup documents like the resolution, board minutes, the memo, with all the Companies Act references. And that loan agreement says if you draw down, it will be a drawdown on that loan unless it's expressly shown as salary, dividends or expenses.
Absolutely fine.
Does that work?
Yeah, in my belief it works. I know somebody wrote on Accounting Web, oh, it needs to do this and that. I think it was Ewan. It needs to do this and that. Might just have a little troll around and see. My company law is absolutely hopeless. I have to look it up every single flaming time. But if you're comfortable that you've knocked the company law on the head, you're fine. You're absolutely fine. Yeah. Any more questions? Look, you got me as a captive. You can ask me anything you like, not about what I've talked about. Lady here. Where's the mic? Yeah, lady here.
On the universal credit, where they're doing the monthly returns, how much tying up will HMRC do to the annual accounts?
Okay, the question is, on universal credit, when you're doing monthly reports, how much tying up will HMRC do to the annual accounts? The answer to that's got to be absolutely none, because it'll never ever agree. You know, the concept that these 12 single months will add up to a year is going to be reporting profits of 200 grand. Because we got a bit of minimum wage thrown in as well. We'll have a bit of that. That's absolute shambles. I mean, you know, we got the final regs on this. I don't think the person who wrote the regulations has ever even met an accountant, let alone a self-employed individual. It's just barking. But you see, I'll tell you what, you know, this is the problem. There aren't very many self-employed people, to which the answer is, oh yes there are a few million, but there aren't very many in relation to the number of employed people. So they always get pushed to the side, they always think, oh well, we'll worry about them later, they're just a small part of it. But, you know, now we're on fallout time. Okay, any more? Yeah.
This one's about the VAT flat rate scheme.
Right, yeah.
Okay, now suppose you get a new client working from home. Obviously the flat rate scheme is beneficial to them, but they've had some pre-incorporation expenditure or maybe some upfront stuff like computer equipment. What I've sometimes done is say, don't go on the flat rate scheme straight away. Leave it a month, claim back all your input tax, and then go on the flat rate scheme. So 2 questions there. Firstly, is that okay? And secondly, can you time all your month 1 invoices for the first week of month 2 and claim back the flat rate on them too?
Okay, that's a really good question. Now, dredging deep, have a look at the flat rate scheme leaflet. I think it does say something about pre-registration expenditure. And I can't remember whether it says you can have it or you can't have it. You can have it. So you could go FRS from day 1 registration and you'd be able to claim back your so in other words, what you're doing is fine, but actually what you're losing out is the benefit of that 1% discount, because you only get that for the first year. So, okay. Secondly, you asked, is it okay to time all your invoices to the month 2 so that you can flat rate them? Right, I'm going to answer that question with the question, do you know your tax point rules? And they're quite challenging. If what you do, let's say today I'm going to bill Sage, let's say, and let's say that that is a basic tax point. Okay, it's the date I perform the service, which is easy for me because it's like one day here, one day there. Okay, now then, what the tax point rules do is they allow me a certain amount of time, which the standard is 14 days, to issue a tax invoice. If I don't issue a tax invoice till then the tax point reverts to the basic tax point. Otherwise, the date's the invoice date. Now, can you see that if it is a basic tax point supply, it might not be, it might be a continuous supply. But if it is, you can see that you might fall foul of that and they might whiz back into the period, and that determines which VAT return they go on. You're a cash accountant, you don't care what tax point it is, you do it when you got the money. But actually what that does is that would determine the correct accounting treatment for it. Now I know, and now I'm digging real deep, that you can extend to 28. And my brain is saying it might have been extended to 28 last time we changed the rates. So have a look in Notice 700 under tax point, and now you know what you're looking for. You're looking for basic tax point, and when I raise an invoice in relation to that, and you'll be fine. 6 minutes left, yeah?
Property tax.
Oh, that's not working. Hold it a bit closer, see if I can hear you.
It's about property tax. Are you happy to take a...
No, it's still not working. I don't think it's working, is it?
Property tax, is it?
Property tax,
yeah.
okay.
Are you happy to take a question on that?
Yeah.
Elderly pensioner lived in a home for a year with the intention of renting it out and took her time to get it up to scratch, basically, undertaking a lot of repairs, then moved out. Is that expenditure pre-letting deductible?
Okay, right. For everybody else, just to make sure we're clear on what the question is, she bought somewhere that she was going to let. She moved in and was 3 years refurbishing it, and now she's moved out and she's actually going to let it. And the question is that expenditure allowable against the letting income? Now, this is a difficult call. Go through it. I'm not going to chuck it out straight away. I know HMRC would. Let me turn it on its head and say, I've got a client with loads and loads of properties, and here's what I do. If there's a decent kitchen and a decent bathroom, and it's all there, if he decides to just put a new bathroom in a white suite as opposed to avocado, I tend to regard that as okay, as an allowable expense, on the basis that you could have let it as it was, but you just decided to spruce it up a bit. If, however, and the clue to me was in your question, is that it probably wasn't suitable for letting until she'd done all the work. And if that's the case, they would regard it as capital. You'll still have it as capital because she's going to get a capital gain on it. I know you're going to get PPR. Question, are you going to get PPR? She bought it to rent.